The negative reaction that we saw in growth companies really towards the end of Q3 was something that I think had started a year before that, when we saw in the summer of 2018 real expansion in multiples. And the reason primarily that was the case was because a lot of other areas in the market were relatively unattractive as we started to have this trade war start to build with China, and flattening of the yield curve, with yields declining. And so money was shifting into areas where growth was more visible and durable, and a lot of that money came into the higher growth companies, particularly within technology. And that started to unwind when the market sold off the end of last year, and then we had a quick snapback in the first part of this year, and then with Uber going public and WeWork starting to engage with public investors to go public, I think new fears emerged that some of these growth businesses on the inside were less pretty than they looked on the outside. We just started to see, while the market for Q3 was relatively flat, money started to shift away from the higher growth companies where success had been and started to shift into safety areas. We have a range of different businesses in the select strategy. We have a little bit less than half the portfolio are in disruptive, high growth businesses. And we have always found opportunity when that market area of the market sells off to really sift through, concentrate the portfolio in some cases of allocating bigger weights towards some of our higher conviction companies, as well as find some companies that were on our list of things that we liked, but we just thought they were too expensive. One of the other areas of opportunity for us is the evolving opportunities segment of our portfolio. And those are companies that we think of as more sort of like classic value companies. These aren't more commoditized businesses, but they're businesses that have fallen out of favor, that are unloved for a variety of reasons. One of those companies that we've added to the portfolio over the last year or so, and we've increased through the last couple quarters, is Lowe's. They have had a series of misexecutions on improving their business and trying to keep up with Home Depot. We have a very astute new management team that's come in under new watch. He's instituted a number of supply chain improvements, pricing, inventory management, working with vendors differently, and re-accelerating growth in the e-commerce channel. And so we see a number of catalysts that are playing out right now. And we have a stock that trades at around a 20+% discount to peers at around a market multiple we think is very unloved. So we think as these positive catalysts play out, earnings and revenue trends are going to be higher than what people expect, and then the multiple should re-rate higher as well. With the election roughly around a year away, there's a tremendous amount of attention around that. Along with, I would say, the other thing that's closely watched is the trade dynamics between us, primarily us and China, in addition to UK and the Brexit situation there, but I think that's really a secondary. The road towards an agreement with China is still pretty long. There's a lot of complicated nuances that need to be ironed out before we're there. And in the meantime, we're continuing to see CEOs and purchasers of products and goods start to continue the recoil process. So I'm really paying attention to those dynamics on the business level to give us indicators for where there's going to be opportunity and where there's going to be risk.